The broadcast is now starting. All attendees are in listen-only mode.
Hey, good morning, everybody, or good afternoon, depending on where you're joining us from. Real quick, I just want to take a quick audio video check. If you could, type in the question box if you can see my screen as well as hear my voice. Awesome, awesome. We will get started then. Welcome back to part two. I know we had a lot of people that joined us for part one yesterday, and as well as I see if several new names popping up here. I'm Dan Cook, Director of Business Development here at Nadex. Do a lot on the operations side, and really happy you could join us. Been in the markets a long time, and definitely education is very near and dear to my heart. It just is so important for the best probability of success in the markets. Trading isn't easy, so it's very important. We have a lot of education. We're working on a lot more for you. So if there is anything, I'm going to ask for some feedback in a little bit. If there are anything that you want to see as far as education that we can produce for you that we might not already have, one of the things I'm working on is, which will be ready in a couple weeks, is actually just how to build a trading plan. Very simple thing, but often very overlooked or confused. And so that's one of the things we're working on. But any topic you want to hear, maybe you've heard about something in the market and you're wondering about, a certain indicator or things like that, happy to put together some specific information for all of you joining us. As we're going to start doing now, as I mentioned, I've been around a while. I've been trading, gosh, well, I placed my first order in 1997 and placed a lot of orders for the following few years during the tech bubble boom. I often say, well, I placed my first order starting in 1997. I didn't start trading until about 4 years later in 2001. Made a lot of mistakes over the years. I've had the opportunity to work with thousands of individuals as a trading coach, trader, and I've worked with everybody from the newest traders to people that have been around 40 years. So that's the part that's near and dear to my heart. And I wanted to start out, this was one that I just, for some reason, popped in my head earlier today, just a trading quote. And this was actually by Ben Stein, who said, I'm going to paraphrase here, I don't have it sitting in front of me, but basically he said, nobody's too stupid to make money in the markets, but a lot of people are too smart. And this, I think he said this about 15 years ago, but it's always stuck with me. And I know when I first started kind of my trading journey, and this is a journey that goes on for a life, I think that's why we all love it so much, is that when you get into trading, we often have a tendency to overthink things or overcomplicate things. I know when I first got in, I started reading about an indicator, and then I'd put that indicator on my chart. Then I'd run over and I'd hear about this strategy. I'd try to implement that strategy, and I was just kind of all over the board and not consistent. And I really think what Ben, without the benefit of being able to ask him personally, meant by that was we tend to overcomplicate it. Instead of doing the simple things and the basics really well and being consistent, we tend to kind of run all over the place. We overcomplicate it for ourselves. And I'll say over the years, the best traders that I've ever met were ones that had a very simple method that they could replicate consistently over and over and over again. And you see it, throughout life. You look at a professional in any sport. I'll take golf as an example. Every golfer that's at the pro level, you'll typically see the same setup when they go to the hole. They look at the hole, maybe they waggle their club a couple times, but it's always exactly the same. And they're basically getting themselves in their mindset. One of my mentors, who had been trading for about 30 years at that time, literally would wake up every day at the same time he was trading. He lived on the beach. He would take a walk down the beach for about a mile. He would get his coffee right after that, and he would sit down, and that was his mental prep. Now, I'm not saying that that's what everybody has to do, but with this consistency and keeping it simple, you have to have a method that you can replicate over and over and over again. And I'm going to be talking about this in further webinars, but just something to think about. If you're getting all frantic or you're trying to, just jump from one thing to the other, something to keep in mind as you're going through your trading journey. So with that, let's go ahead and get started here. We're going to be talking about the Nadex product set today. This is part 2 in the Pro Series. And before we begin, I want to remind you of the risk disclosure. Trading on Nadex does involve financial risk, and it's not appropriate for everyone. Anytime you put money into a real market, whether that be Nadex or the futures or currencies, you stand to lose that money. Now, the one thing that I'm very happy, and I've been at Nadex now for about 8 or 9 years, and I've been working with Nadex since about 2008, so actually coming up on 11 and a half years here. And one of the things that I've always appreciated was that there's no margin calls. So there is risk. You need to understand that. One thing I'm very proud of, though, is that you always define your risk, and you won't ever lose any more than you put up for a trade. Now, that said, you still have to have good risk management skills, right? Because if you have $1,000 in your account and put $1,000 risk on one trade and you lose that, then it's gone. We're going to be talking a lot about risk management in some upcoming educational webinars as well. But understand that there is risk in trading. Trading's not easy. It's a great pursuit. Just understand that risk aspect of it. Oh, by the way, real quick on risk, it should always be risk capital. Or freed up, basically, money that you're using when you're trading. Don't ever try to trade with grocery money or something that really needs to be allocated for other bills. It just will not work. As far as the content here, it is subject to copyright by Nadex. Please don't redistribute it or send it out without our written permission. So any recording, reproduction, just not authorized unless we give you permission for that. Alrighty, we got the disclaimers taken care of, so let's get rolling. By the way, as far as questions, a lot of it will be answered towards the end, but if you do have a question, type it into the question box. I may or may not get to it right away, but I will address it throughout the webinar. Just want to respect everybody's time this morning, and because I know we're scheduled here for about 20-30 minutes. So what we're going to be talking about today, we're going to just walk through the product sets: binary options, touch brackets, and call spreads. So let's get started with binary options. A binary option is a simple yes or no statement, right? It basically asks a question. Will this market be above this price at this time? And on your screen, you should see an example of an order ticket there. So if we look at the top of the order ticket, we can see Wall Street 30. This contract is our Nadex Wall Street 30, which is based on the CME E-mini Dow contract. If you ever have any questions about what the underlying market is that's associated, on the Nadex website, you can simply look at the product set and there's a contract specification page. If you're interested in what the underlying markets are, for example, the US 500 is based on the E-mini S&P 500. Oil is based on the CME crude oil contract. So understand what the underlying markets are, but basically it's saying, will this market, in this case, be greater than 26,110 at 4:15 p.m., and then you'll see the expiration date. One thing I do want to clarify, which just isn't specific to binary options, but all of our futures-based contracts, you'll see a contract month here. Right after Wall Street 30, it says June. In this case, that was the underlying market. In futures, they have what's called a roll, and so they have different contract months where that contract is expired, and then you roll to the next month. So for example, you might see Wall Street 30 June, and then when that rolls, it'll be Wall Street 30 Sept. That has nothing to do with the expiration of the actual Nadex contract. That is just what the underlying market's based on. So I want to alleviate that confusion right now on all of ours. This is not expiring in June. When you see this on the order ticket, if you look at a lot of the contracts now, they'll say DEC, which is December, right? They're always going to expire on the time and date listed. Want to alleviate that confusion. You'll also have a countdown timer right there that tells you how long it is. If it's a weekly, it might be 2 days out. If it's if it's a 5 minute, it might say 2.5 minutes. You'll see what the Nadex indicative index is. That's representative of the underlying market. Again, it's indicative. So anyway, let's get back to binary options. The binary option, they're all $100 contracts. That's the maximum value of the contract. So the price goes from 0 to 100, right? These are considered all or nothing contracts in that at expiration, you're either going to receive $100 or you're going to receive $0 at expiration. Now, I want to talk a little bit about that because that's oftentimes confusing for people. They think, well, it's all or nothing. I have to hold it till expiration. You do not have to hold it till expiration, right? So if you buy a contract at 30 and it moves to 65 or 70, and you think the market's starting to slow down a little bit, you can close out that contract. But let's walk through the risk-reward aspect of a binary option. If you're a buyer of a binary option, your maximum risk is wherever you buy that option to zero. If you're the buyer, you're basically saying, yes, I think it will close above this level, right? If you're holding it till expiration, that's your answer. In this case, will Wall Street 30 be greater than 26,110? I'm a buyer. I think that's yes. My risk is wherever I buy. In this case, we're looking at 72 to zero. So I'd be $72 per contract with a maximum potential return of $28. Now you may say, why would somebody do that? The price of a binary option is really based on probability, right? It's what the market's reflecting as the probability of that event occurring. So for example, if I buy at 72, which is the midpoint, if we look on the order ticket, we have a bid offer of 67.50, 74.75, right? I might try to work an order. I don't just have to take what they're offering me or what the bid is. I can try to work my own price. Another important aspect about Nadex, it's an exchange. Every one of our members can be their own market maker. So in this case, if we're looking at 72, putting up $72, that's the risk, but we're looking at putting the probabilities, in this case, in our favor. We might be saying, you know what, it's already what's called in the money, which just means in the case of a binary option, it's considered in the money when the underlying market is over the strike price. Deep in the money, you might see priced at like a 92 to 96, right? One thing I'll caution, just because it's a high probability does not mean it's a guarantee. No guarantees in trading. The only guarantee here is that it will never go below zero or over 100 in price. Doesn't matter what happens in the world, right? You can have geopolitical tensions, a lot of different things. This contract can never go beyond those boundaries of 0 or 100, right? If I'm a seller of this contract, right? If I'm a seller at 72, my risk is wherever I'm selling, the difference between 100 and wherever I'm selling. In this case, real quickly, if I take 100 minus 72, if I was a seller, my risk would be $28, right? I'm saying the market's really going to move. Typically, what we'll see is if our traders and people are expecting volatility, say around a news announcement, you're typically looking at a lower risk, higher return trade, right? Because you're expecting a big movement. Whereas if you're expecting slower markets, and this is one of the great things about a binary option specifically, is when you have slower markets, you're not expecting them to move. So if it's already in the money, you're looking for price basically because it has to settle at 0, 100. If price just stays where it's at, goes a little bit higher or even goes slightly lower but stays above that strike price, just by virtue of time, it will move to $100, right? If it's already in the money. If it's out of the money, it'll have the opposite impact because it has to then, if it doesn't move at all, only goes slightly higher or goes slightly lower, but basically stays flat, price will degrade to $0. It's just the function of a binary option. Again, want to keep it very simple, right? It always says right on the order ticket what your maximum loss is going to be and what your maximum potential profit will be. It's not inclusive of exchange fees, which are $1 per contract. And then if it goes to expiration and you get the $100, it's $1 per contract. However, if it settles where you get zero payout, so if you were a seller and it settled at 100, or if you were a buyer and it settled at 0, then there's no expiration fee. One thing I would recommend if you're very new to binary options, check out our education center. We've got a lot of great webinars. If you're looking for strategies, there's a lot of great webinars in there. But definitely spend some time on the demo account. Binary options, while we say they're often simple, they can get very, I don't want to say complicated, but you can actually do some fairly complex strategies with binary options. But you want to make sure your strategy is always suited to the specific market conditions. And again, these webinars in this particular case are really just meant to give you a little bit of a flavor for the contracts. They're not going to be all extensive, just by virtue of time. All right, let's hop on to our newest contracts, touch brackets. Touch brackets we just launched in January of this year. We're actually looking at expanding this particular contract line as well, but we really wanted to get in and see what we needed to improve as far as the contract, really get them out there, get the liquidity built up. These basically, what I like in their design, and one of the things that I've seen in trading over the years, is oftentimes people don't have a plan for every trade, meaning they don't really plan for their exit strategy on both sides. I've seen, particularly back in my days of the futures and forex world, where people would place a trade and they might put a stop on because they're trying to manage their risk, and the market would start moving against them. And all of a sudden, the stop's moving farther and farther and farther away, and they're taking on too much risk. It's a matter of psychology and discipline. On the other side, I can't even count the number of times where somebody would buy a contract and it would rocket in their favor, right? It would just shoot up, but then they'd never take profit. They thought it was going to run forever, and all of a sudden the market makes a severe downturn, and now they're sitting at break even or worse. And so that, again, was a matter of discipline, knowing when and not getting too greedy. What I love about this contract is it actually has that plan built into it. It moves very much in linearity with the underlying market. That's how it was designed, right? So in this case, it's not an all or nothing. If I'm a buyer, similar to a binary, if I'm a buyer, the floor is my maximum risk. The ceiling is my maximum profit objective. If I'm a seller, right, the ceiling represents my maximum risk. The floor represents my maximum profit target. And if the indicative price hits either of those levels, that contract is automatically expired and then replaced. These are a maximum duration of 1 week, right? They can be knocked out, or expired in one of two ways. They can be expired by touch, meaning if a floor or ceiling gets touched, or by time. At the end of the week, these are going to all expire. Typically it's Friday or the last trade date of the week if there's a holiday on Friday, right? So the way they're designed, and again, just like all Nadex contracts, fully defined risk. This contract can never go outside of the floor or ceiling as far as a value level. So you'll always see on the order ticket your maximum loss, maximum potential profit. If you're already trading futures, these are basically designed as the equivalent of a micro futures contract or mini forex contract. The way they're structured is with multiple brackets. So if I'm looking at this structure here, right, what we wanted to create was an opportunity, whether you wanted to be long or short the market, where you could get in with a lower risk, higher potential profit type trade. So in this scenario, if I was looking to buy this contract, I might select bracket number 1, right? Because if this is the floor of bracket number 1 and that green line represents the price, that's going to be my lowest risk, highest potential return to the ceiling. Now, I always want to make trading decisions, right? Just because it's the lowest risk doesn't mean it's always the best trade. For example, if this market was already very close to the floor of number 1, that might not be enough room to let the market breathe. I might want to take on a little bit more risk, let the trade work, and choose bracket number 2. On the other side, if I want to be a seller, right, I might choose bracket number 4, because if that green line represents the underlying indicative market and this represents the top of the bracket, if I'm a seller, that's going to represent my lowest risk, highest reward return. If a bracket is knocked out, that bracket will automatically be replaced. So you see how that stair step line works? So let's say the market dropped from here and bracket number 1 gets knocked out. There's going to be a new bracket that replaces it, if you visualize it, right next to bracket number 4, and where the floor of number 1 was, where this market is now, will be the new ceiling. One of the great things, and if you're available, and even if you're not, you should register. 2 o'clock today, Adam McAdden, who's been working a lot on our new platform, is going to be giving a walkthrough of the new platform we just put into beta test. Something that's really been missing from these brackets, on the charts, whereas in a binary option you can see all the strike prices, we'll actually have the brackets where you can click on them on the chart, so you get a visual representation of where they're at. So this has been a little bit about touch brackets. Again, if you go to our videos section, we've got a lot of great tutorials right on touch brackets. We're also working on some more additional strategy education for those as well. All right, call spreads. This is a contract actually designed back in, 2009, I think I spec'd these out. These are structured very much like touch brackets. The biggest difference is if it goes to the floor or ceiling or even surpasses it, you are not knocked out. While you're not knocked out, they still represent your maximum risk. These are a variable payout contract, so they're not all or nothing, so don't confuse them with binary options. Rather than being exactly linear, as a touch bracket would be, which gets knocked out, these actually introduce what's called optionality. Optionality is basically insurance, right? It's a premium. You're basically paying a bit of a premium to protect your risk, similar to anything you have, right? If you have a house and you pay insurance on that house, you're basically paying a premium every month because if something really catastrophic happens, or even not even catastrophic, but if something pretty major happens, you've paid that premium to protect yourself. Call spreads are really the trading equivalent of that. You pay a little bit of premium when you enter the trade, and depending on volatility, right, that could be a little bit more if volatility is high or a little bit less if volatility is low. If you're new to options, don't get scared away by them. This is a great way to start learning about things like delta, which is basically how the market moves in relation, the underlying market moves in relation to the contract, as well as time value or theta. So it's a great way to start introducing yourself to options if you're not already trading them. Again, you'll always know your max loss and max profit. The way this contract works, so let's say I was buying at 26,170. My floor is 26,100. In this case, I have $70 risk, which is the amount of capital that I also put up to secure the trade. But let's say something big happened, and all of a sudden the market drops to 26,050. So it's 50 points below the floor. Instead of being knocked out, I'm still in that trade. I'm already at my maximum potential loss. But if you've been trading for a while, and I think anybody that's traded over a week has had this happen, where you get into a trade, and let's say you're buying. You put in a stop loss, you're trading futures or forex, you put in a stop loss, which you have to do to manage your risk. The market drops against you, hits your stop, and then all of a sudden it just rallies in what would have been your favor. It's almost like the market had eyes, right? It's happened to every trader. It is a natural part of the market when you're using a stop order. What's great about these contracts is that you're basically buying time to be right. So let's say you got into this trade early in the day and it's daily. It drops to 26,050. Now, if it stays down there, this contract is going to close. Let's say it expires at the end of the day. This contract is going to close at 26,050 as the expiration value. Your loss is still capped at $70. But let's say that all of a sudden there was a severe move right after you first got in, and all of a sudden the market's at 26,050. If then the market rallies, and let's say it rallies to 26,300 right there in the middle, you're still in that trade, right? Because you didn't get knocked out, you're never stopped out, you're basically paying that insurance premium to sustain adverse market moves and buy the potential to be right in the end. If the market rallies, let's say it just rallies, you're a buyer and it rallies to 26,600. Your maximum potential return is 26,500. So you still have the maximum boundaries, but you're never knocked out of that trade. The way the profit loss works, if you're a buyer or seller, it's simply going to be the difference, and you let it go to expiration. It's simply going to be the difference between where you bought or sold and where it expires. So for example, if I bought this at 26,170 and the market expires at 26,300, I'm going to realize the profit difference of 26,300 to 26,170, or 130 points, or $130 per contract. Again, not all or nothing. If it settles at 26,200, well, then I've made $30, not inclusive of exchange fees. If it settles at, and I'm a buyer, and it settles at 26,120, so it settles down here below where I bought, I'm going to realize a loss, not the full loss of $70, but a loss of $50 if there's a 50-point difference. Again, I encourage everybody to try these contracts in our demo account first. They all kind of offer you unique kind of ways to trade. I see a lot of people like trading binary options, particularly around One, really slow markets where there's not much going on, but they're still looking for opportunities, or in what could be severely volatile markets, like around a Fed decision, or if you're looking like a European central bank and you're trading currencies, or a non-farm payroll type decision. There's some great strategies on binary options. If you're looking for volatility as well, there's some great strategies for call spreads. You may have to pay a little bit extra premium, so there's always something to consider. With touch brackets, if you're looking for something that's very linear and you're looking to take advantage of high effective leverage, then you might be looking for a touch bracket. Particularly if you've traded futures or forex before, these will be the most similar, the touch brackets will, to how you're used to the market moving. But I definitely encourage you to try them all in the demo first, and see what you think, what fits your style best. By the way, one last thing on the call spreads that I want to mention is that we have multiple ranges. So depending on what you're looking to do, if you're looking to be more short term, right? The shorter term, the less premium you're going to pay. It's a function of time as well as volatility. But as the market moves, we always want to keep a common floor or ceiling. So for instance, if this is the market at 8 a.m., whoops, and the market moves, our next set of 2 hours are going to move with the market, so that we're always looking for opportunity, right? You have really wide ranges in most markets, and then you have a little bit more narrow, and then a little bit more narrow. Alrighty, and so for questions and feedback, again, I'm going to encourage everybody to join the webinar this afternoon that's going to be hosted by Adam. And give me 1 second. Actually, I'll bring that up to the screen and show you where you can register for that if you haven't already. One moment here. I thought I had it up. I'll take you to our web page here. If you're not familiar with it, and this is where you can find a lot of education as well. Hopefully everybody can still see that. Yep, as far as the question, there will be a replay. It'll probably come out in a few hours. But everybody that's registered, actually with all of our webinars, we always record them. And so there will be a link sent out where you can view the webinar afterwards. So if you did come in late, you'll be fine. We'll make sure you get a copy of it. So underneath the Learning Center, we have some educational courses. To register for this afternoon's webinar, simply click on Webinars. For upcoming, right, we have another one, Forex Market Breakdown, which actually took place. That recording should be going out soon. This is Nadex Pro Series, the new platforms walkthrough. That's this afternoon. Again, even if you can't make it this afternoon, register for it. Just click the yellow button for register. It's very simple. You'll get a recording of it. The new platform is looking awesome, so I'm very happy about it. And it's going to have a lot of cool new tools that are going to be available that we just couldn't implement in the old one. All right. Questions and feedback on webinars. Like I said at the beginning, we're interested in hearing your opinion of what you'd like to see on the webinars. So give us questions, give us feedback on these webinars. If you have an account with Nadex, your account specialists can be reached at 312-884-0162. They can take care of any account questions. Our customer service is great. We have customer service 24 hours a day during all days that the market is open, starting on Sunday afternoon and going all the way through Friday afternoon when the markets close. And it looks like I've got a couple of questions here. Yeah, we will be on the touch brackets. We are looking at potentially adding some additional currency pairs as well as a couple of commodities. I'm in the process actually of doing all the specifications for those currently. Everything has to be, because we are CFTC regulated exchange, everything has to go through obviously compliance. We have to make sure that the contracts are structured well. They go through a lot of testing. We obviously can't turn anything loose before it's thoroughly vetted, tested, make sure we've identified to all practicality any surprises that we might see with that, right? That's our number one thing. We want to keep a fair level playing field, and we want to keep a very reliable, stable trading venue for all of our members. Okay, and yeah, as far as the contracts, so at expiration, this is one, binary options at expiration are always going to be either 0 or 100. That's the only two ways that they can settle at expiration, 0 or 100. The call spread contract is what's considered variable. So wherever it settles, if it settles within the range, profit and loss is going to be determined by where you bought or sold, and then where the market settles, right? If you bought it and it settles above where you bought, then that's going to be your profit. That profit could be $10, could be $1, could be $300. It all just depends on the contract and where you bought or sold. And the loss is also not all or nothing. So let's say you bought $100 from the floor, the market drops 50 points, expires, you would realize a loss of $50, not the 100. That was your maximum risk to get in with. Touch brackets on expiration can expire two ways, right? If it hits the floor or ceiling, it's going to be knocked out at that level and expired exactly at the level of the floor or ceiling. So that will determine your profit or loss, whether you were long or short. And then at the end of the week, they'll expire very much like a call spread. Any active contracts, the four brackets at the end of the week, they're going to be what's called a variable payout, like the call spread. Your profit loss is going to be determined where you bought or sold and the closing level of the market. Oh yeah. By the way, just to let everybody know, we are going to be revamping. We have a lot of education on our website, and we've tried to do a good job of organizing it. But what we're looking to do now is actually really uh, enhance that experience and give people a clear pathway to education. We have a lot of members that are not only new to Nadex but also new to trading, and we want to give them all the tools they need. We can never guarantee someone's success, but we do want to give everybody every tool they need to give them the best probability or the best shot at being successful in the markets. Cool. I think I covered all the questions. If not, if you do have any questions or anything you think about later, again, if you go to our website, just hit us up. There's a contact button on just about every page. Give us a call. We'd love to talk to you. And with that, I'll wrap it up. Thank you very much for joining me today, and hopefully you can join me tomorrow for part 3, where we're going to take a look really at the charts and some of the tools available there.